March the 9th, 2023, Silicon Valley Bank customers try to log in and check their balances. The app works fine. The numbers are all there, $2,000, $50,000, $2 million, exactly as expected. By March the 10th, the bank is shut down by regulators. In less than 48 hours, depositors had tried to pull out $42 billion. The bank simply didn't have it. Here's the detail that should genuinely unsettle you. This wasn't a hacking incident. Nobody stole the money. The bank wasn't secretly empty the whole time, running some kind of fraud. It failed because of something completely legal, completely normal, and true of every single bank in America, every single day. If you have $10,000 sitting in your checking account right now, here's an uncomfortable fact. Your bank does not have $10,000 sitting in a vault with your name on it. It never did. So the real question isn't whether your bank is secretly untrustworthy. It's this. If the money isn't actually sitting there, what exactly are you looking at when you check your balance? Why this matters now? For most of your life, this question never comes up, because banks almost never fail. You deposit money, you withdraw money. Everything works exactly as expected, and the underlying mechanism stays invisible. But 2023 was a reminder that the mechanism is always running in the background, and it can break. Along with Silicon Valley Bank, Signature Bank and First Republic also collapsed that same year, making it the second, third, and fourth largest bank failures in U.S. history, all within a matter of weeks. And this wasn't some obscure crisis limited to Wall Street insiders. Regular businesses couldn't make payroll. Startups worth billions suddenly couldn't access their own operating cash, all because of a system most account holders have never had explained to them clearly. How your money actually works inside a bank. Let's break down the real mechanism, step by step. This system is called Fractional Reserve Banking, and once you understand it, banking stops looking mysterious, and starts looking like exactly what it is, a carefully balanced bet. Step 1. You deposit money, and it stops being yours in the way you think. The moment you deposit $10,000, legally, that money becomes the bank's asset, and you become the bank's creditor, meaning the bank now owes you $10,000. It's not sitting in a labeled box, it's merged into the bank's general pool of funds. This is normal. This is by design. It works every single day, for one specific reason. Most people, most of the time, don't ask for their money back all at once. The hidden math nobody explains. Here's where Silicon Valley Bank's collapse reveals the deeper risk almost nobody talks about. Banks don't just lend money out as loans, they also invest a large share of deposits into government bonds and mortgage-backed securities, considered extremely safe assets. Silicon Valley Bank had invested tens of billions of dollars into long-term government bonds, back when interest rates were near zero. Then, through 2022 and 2023, the Federal Reserve raised interest rates sharply to fight inflation. Here's the critical mechanic: when interest rates rise, the market value of existing, older bonds, which pay lower, outdated interest rates, falls. Silicon Valley Bank was sitting on billions of dollars in unrealized losses on these bonds. On paper, on their internal balance sheet, those losses were real, but invisible to depositors, because the bank hadn't been forced to actually sell the bonds yet. Then a specific kind of panic set in. Silicon Valley Bank's depositor base was unusually concentrated, heavily tech startups and venture capital-backed companies, many with deposits far above the $250,000 FDIC insurance limit, all connected through the same tight-knit investor networks. When word spread that the bank might be in trouble, it didn't stay contained. Because of social media and instant mobile banking apps, this became the first bank run in history to happen at internet speed. $42 billion withdrawn in a single day, a scale and speed that older banking regulations were never designed to handle. To cover those withdrawals, the bank was finally forced to sell those bond holdings at a loss, converting paper losses into real ones, instantly wiping out the bank's capital cushion. The bank didn't fail because it was reckless in an obvious way. It failed because a slow-building, largely invisible risk collided with a uniquely fast, modern kind of panic. Hype versus reality. The "my money is safe" illusion. The comforting assumption most people carry is, my money is in a federally regulated bank, so it's completely safe, full stop. The more precise reality: your deposits are protected by FDIC insurance, but only up to $250,000 per depositor, per bank, per ownership category. Silicon Valley Bank's collapse was so alarming specifically because a huge share of its deposits, startups holding millions in operating cash, sat well above that insured limit. In that specific case, regulators made an emergency decision to guarantee all deposits in full, insured or not, to prevent a wider financial panic from spreading to other banks. But here's the irony worth sitting with: that guarantee wasn't a guarantee guaranteed right depositors could count on in advance. It was a discretionary emergency decision, made under pressure, in real time, that could have gone differently. Your money is safe in the bank is true in the overwhelming majority of cases, almost all the time, for almost everyone. It is not the same statement as, your bank is currently holding your exact money, untouched, ready to hand back the moment you ask. Zooming out, why this isn't just about one bank. Every bank in the country runs on this same basic structure. Reserves are a fraction of deposits. Deposits are actively invested and lent out. The entire system depends on the assumption that depositors, collectively, won't all panic and demand their money back at the same moment. This is precisely why bank runs are contagious by nature. When one bank fails, it doesn't just raise questions about that one institution, it raises the exact same uncomfortable question about every other bank built on the identical model. That's exactly what started happening in the days after Silicon Valley Bank collapsed, as regional bank stocks across the country dropped sharply, driven by fear rather than any actual problem at those specific banks. The Federal Reserve's role as a lender of last resort, stepping in to provide emergency funding to stressed banks, and FDIC insurance, exists specifically to prevent this kind of panic from cascading through the entire system. They've worked well for decades, but 2023 was a clear reminder that the system's stability depends on confidence holding steady, and confidence, unlike a bank's balance sheet, can shift in hours, not months. The closing thought: so the next time you glance at your banking app and see your balance sitting there, neat and precise, remember what that number actually represents. It isn't a receipt for cash sitting in a vault somewhere with your name on it. It's a promise, a legally backed, historically reliable, but fundamentally not risk-free promise, that the bank will hand you that amount when you ask for it, assuming enough other people aren't asking for their money back at the exact same moment. Which leaves behind a question worth sitting with. If an entire banking system runs on the quiet assumption that everyone won't ask for their money back at once, what does it actually mean to say your money is sitting safely in the bank?